Welcome back again to the Sharing Channel. Today we're embarking on a pivotal journey through 2024's global financial shifts. Together we'll unpack the transformative changes reshaping our economy and explore trends that are not just changing the markets, but redefining how we approach investing, trading, and financial planning in an unpredictable world. So stay tuned, because the insights you gain today could shape your financial future.
First chapter takes us into the global economic growth and inflation trends of 2024, a year marked by a blend of challenges and cautious optimism.
Economic growth is expected to remain moderate, with a global GDP growth rate around 3.1% in 2024, slightly up from earlier estimates, but still below the pre-pandemic average of 3.8%. This reflects resilience in some advanced economies, such as the US, but also the challenge of slower growth in key regions like Europe and China.
Global inflation has seen a notable reduction, with average headline inflation projected to fall to about 5.8% by year-end, down from the highs of previous years. This improvement stems from easing supply chain issues and tight monetary policies across advanced economies. In the US and Europe, inflation rates are trending closer to central bank targets, but inflation in services remains elevated, particularly impacting sectors like housing and healthcare. For 2025, global inflation is forecasted to decline further to approximately 4.4%, continuing the path towards stability.
Major central banks in developed economies have begun pivoting from aggressive rate hikes to more balanced approaches, with gradual cuts anticipated in some regions. For example, the U.S. Federal Reserve is moving towards a neutral stance as inflation pressures ease, while emerging markets benefit from improved currency stability as their economies face less inflationary pressure. This shift in policy is expected to support economic recovery without sparking new inflation.
U.S. growth has been resilient, supported by strong consumer demand and favorable employment trends. However, fiscal restraint is expected as debt levels remain a concern. In China, growth has slowed, projected at around 4.5%, largely due to weakened domestic demand and ongoing policy adjustments aimed at stabilizing debt and property markets. The EU faces unique challenges, including low productivity growth and structural constraints, with GDP growth projections under 1.5%. Inflation remains relatively high in services and energy, though it is expected to moderate through policy adjustments and support measures in energy-dependent sectors.
Risks to global economic stability persist. Increased geopolitical tensions, lingering high inflation in specific sectors, and potential fiscal instability are highlighted as ongoing threats. Many emerging economies are also dealing with the pressures of elevated food prices and commodity market volatility, which could impact inflation control efforts and economic resilience in these regions.
In some emerging markets, inflation remains a concern, particularly due to rising food prices and fluctuating commodity markets. This uneven inflation pattern highlights the need for targeted policies that address specific regional issues without undermining the global recovery effort.
Many countries are now focusing on stabilizing their finances, a crucial step in reducing national debt and building economic resilience for the future. The next few years will likely require careful fiscal management to balance debt reduction with growth, especially in regions experiencing economic strain. While inflation trends have improved, the global economic outlook remains complex, calling for proactive and balanced policies to ensure stability moving into 2025. This chapter has offered a snapshot of the complex economic landscape of 2024, and as we move forward, fiscal and monetary decisions will play a pivotal role in global stability.
In this chapter, we explore the key movements within three vital sectors of the economy: the stock market, Federal Reserve and interest rates, real estate, and commodities.
In 2024, major market movements across the stock market, real estate, and commodities have shown notable trends.
The S&P 500 has experienced a robust increase, rising nearly 21% year-to-date as of October, marking its best performance for the first 3 quarters of any year this century. This uptrend comes amid a cautiously optimistic economic outlook, with GDP growth estimated at 3.1% for Q3. The Federal Reserve recently cut interest rates by 50 basis points, with expectations for another cut before the end of the year, which has positively influenced market sentiment.
The Federal Reserve and its recent interest rate policies have significantly impacted the U.S. economy in 2024.
The Federal Reserve has recently adopted a more accommodative stance in response to moderating inflation rates. In September 2024, the Fed cut interest rates by 50 basis points, bringing the target range down to 4.25% to 4.50%. This marked a significant pivot from its earlier aggressive tightening strategy aimed at combating soaring inflation that had peaked in previous years.
Several factors contributed to this policy shift. First, the rate of inflation has eased, with headline inflation projected to decline to around 5.8% by year-end, down from highs of over 9% in the previous year. This improvement is largely due to the resolution of pandemic-era supply chain disruptions and improvements in labor market conditions, allowing consumers to feel more confident in their spending.
The resilience of the U.S. economy has also played a crucial role in the Fed's decision-making process. Consumer demand remains strong, supported by robust employment figures, which have helped stabilize economic growth. This growth is projected at 3.1% for 2024, indicating that the economy is on a steady recovery path.
Looking ahead, many analysts anticipate further rate cuts in 2025 as the Federal Reserve continues to balance economic growth with inflation control. The consensus suggests that the Fed is moving toward a neutral stance, which aims to support the economy without triggering new inflationary pressures.
The real estate sector has faced challenges due to rising interest rates, impacting REITs significantly over the past 2 years. However, the market is beginning to stabilize, with expectations that 2024 may offer opportunities, especially in sectors like shopping center REITs, data centers, and senior housing. The demand for retail spaces, particularly shopping centers, has increased as consumers prioritize essential goods, leading to lower vacancy rates.
In the commodities market, energy prices have seen fluctuations, influenced by geopolitical tensions and shifts in supply-demand dynamics. The overall sentiment remains mixed, with some investors looking for opportunities in undervalued sectors such as energy and precious metals as they adapt to changing economic conditions.
In this chapter, we will explore the evolving landscape of cryptocurrency and decentralized finance, DeFi, focusing on their remarkable resilience amidst challenges and the significant regulatory shifts shaping their future.
In 2024, the crypto landscape has demonstrated remarkable resilience amidst a backdrop of regulatory shifts and market fluctuations. As we navigate through this evolving terrain, let's explore the key trends shaping the future of digital assets.
Despite the market's volatility, cryptocurrencies have shown surprising resilience. As of late 2024, Bitcoin is trading at approximately $40,000, reflecting a recovery from earlier lows. Ethereum, now at about $3,000, showcases a similar rebound, driven by increasing institutional adoption and robust DeFi activity.
Decentralized finance, or DeFi, has emerged as a key player in the cryptocurrency space. Total value locked, TVL, in DeFi protocols has surged to over $80 billion, marking a substantial growth from 2023. Platforms like Uniswap and Aave continue to attract users with innovative offerings, contributing to the sector's expansion.
However, this growth comes alongside increasing scrutiny from regulatory bodies. The US SEC and European regulators have ramped up efforts to implement clearer guidelines for crypto assets. Notably, the SEC's proposed regulations aim to classify certain tokens as securities, which could reshape how projects operate within the US.
While the industry shows resilience, it faces challenges, including market manipulation, security risks, and regulatory uncertainty. A recent report by Chainalysis highlighted that over $1.3 billion was lost to DeFi exploits in 2024 alone, emphasizing the need for improved security measures.
Looking ahead, the intersection of cryptocurrency and traditional finance is expected to deepen. As more financial institutions explore blockchain technology, we may witness a new era of hybrid financial products that blend the best of both worlds. By 2025, analysts project that the DeFi market could reach $250 billion in TVL, provided regulatory frameworks are conducive.
Let's explore the current landscape of global trade and supply chains, revealing how businesses navigate and adapt to new realities in a rapidly changing economic environment. Let's deep dive into Chapter 4 on global trade and supply chain shifts. In 2024, the dynamics of international trade are evolving rapidly, driven by a series of challenges and innovations. Let's delve into how countries and businesses are adapting to these new realities. The global trade landscape is witnessing a significant transformation. As of 2024, global merchandise trade is expected to grow by approximately 4%, rebounding from the stagnation seen during previous years. This growth is fueled by a combination of recovering consumer demand and renewed manufacturing activity in various regions. Despite this growth, supply chains continue to face disruptions. Recent geopolitical tensions, particularly between the US and China, have forced companies to reevaluate their supply chains. For instance, nearly 75% of manufacturers reported supply chain disruptions in 2024, leading to increased costs and delays. In response to these challenges, many companies are turning to nearshoring and reshoring strategies. Nearshoring allows businesses to relocate production closer to end markets, significantly reducing shipping times and costs. A recent survey revealed that 50% of U.S. companies are considering relocating manufacturing closer to home by 2025. Technological advancements are also reshaping global trade and supply chains. The adoption of automation, AI, and blockchain technology is enhancing efficiency and transparency. For instance, the use of blockchain in supply chain management is expected to reduce operational costs by up to 30% over the next few years. As businesses adapt, there is a growing focus on sustainability. Supply chains are increasingly prioritizing environmentally friendly practices, such as reducing carbon footprints and optimizing logistics. Research indicates that companies committed to sustainable supply chains can see a 15% increase in profitability. Looking ahead, global trade is likely to be characterized by resilience and adaptability. As businesses continue to navigate geopolitical uncertainties and consumer preferences shift, the emphasis on agile supply chains and innovation will be paramount. By 2025, global trade volume is projected to reach $30 trillion, representing a significant opportunity for growth. To sum up, the shifts in global trade and supply chains present both challenges and opportunities. By embracing new technologies and sustainable practices, businesses can position themselves for success in this evolving landscape. In this Chapter 6, we examine how technology is shaping the finance sector, focusing on the transformative roles of AI, fintech, and digital innovation. As we dive into the realms of artificial intelligence, fintech innovations, and digital transformations, we'll uncover how these elements are reshaping the future of finance. Fintech, or financial technology, has transformed the way we manage our money. The global fintech market is projected to grow from $124 billion in 2023 to over $300 billion by 2030, reflecting an annual growth rate of 15%. This explosive growth is driven by the demand for more accessible and efficient financial services. Artificial intelligence is at the forefront of this transformation. In finance, AI is used for everything from risk assessment to fraud detection. According to recent studies, AI-driven technologies could save banks over $1 trillion by 2030 through increased efficiency and reduced operational costs. Digital banking is rapidly gaining popularity, especially among younger generations. In fact, over 80% of millennials prefer using digital banking services over traditional banks. This shift is pushing traditional financial institutions to innovate and enhance their digital offerings. Blockchain technology and cryptocurrencies are also redefining finance. With a market cap of over $1 trillion in 2024, cryptocurrencies offer an alternative to traditional financial systems. Blockchain ensures transparency and security in transactions, making it a vital tool in finance. As fintech and AI become integral to finance, regulatory bodies are adapting. Governments are grappling with how to regulate these rapidly evolving technologies to protect consumers while fostering innovation. For example, the EU has introduced regulations to ensure the safe use of AI in financial services. Looking ahead, the integration of AI, machine learning, and big data in finance will continue to evolve. Predictions indicate that by 2025, 75% of all customer interactions in banking will be driven by AI technology. This shift will lead to hyper-personalized banking experiences and smarter financial decision-making. On a final note, technology's influence on finance is undeniable and ever-growing. As we embrace these advancements, understanding their implications becomes crucial for consumers, businesses, and regulators alike. In this chapter, we delve into the major trends shaping consumer and personal finance today. We'll explore how spending habits, saving strategies, and debt management practices are evolving, reflecting the economic shifts and consumer behaviors that define our financial landscape in 2024. In an evolving economic landscape, understanding how consumers are spending, saving, and managing debt is crucial for both individuals and businesses. In 2024, consumer spending is projected to grow by approximately 4.5%, driven by increased disposable income and robust employment rates. However, inflation continues to affect purchasing decisions, leading many consumers to prioritize essential goods over luxury items. Despite rising costs, consumers are placing a renewed focus on savings. The personal savings rate has fluctuated around 7.5% in recent months, up from 6.2% at the beginning of 2023. This shift reflects a growing awareness of financial security, particularly among younger demographics who prioritize emergency funds. Debt levels are a significant concern, with total U.S. consumer debt reaching $16.9 trillion in 2024, an increase of nearly 5% from the previous year. Student loans and credit card debts are particularly worrisome, as many consumers face higher interest rates amid inflationary pressures. Inflation remains a dominant factor influencing consumer behavior. A survey indicated that 67% of consumers are adjusting their budgets to cope with higher prices, leading to reduced spending on non-essential items and a focus on value-driven purchases. In summary, understanding consumer behavior in terms of spending, saving, and debt is vital in navigating the economic challenges of 2024. Thank you for watching this recap on the global financial shifts of 2024. This is just the beginning of our year-end series. In the coming days, we'll dive into other significant topics that have shaped this year, from groundbreaking technology and social movements to climate events and health updates. We'll also provide predictions based on these important recaps to help you understand what might come next in these evolving areas. If you enjoyed this video, please give it a thumbs up, share your thoughts in the comments, and subscribe for more insightful contents. We have plenty more insights coming your way. Remember, we're here to keep you informed, inspired, and ready for what's next. See you in the next video.